mechanisms, and you predict that the Chinese will actually increase precious metal prices significantly pretty much overnight. Now, so did you want to discuss a little bit about how what you call the China's new fortified Shanghai helm will enable China to revalue gold and silver prices so rapidly?
The fact that they have the ability does not mean they use it. It's like kind of like owning a gun. Okay, there's a lot of nasty stuff going on in the front street in front of your property. You got a gun. It doesn't mean you're going to use it. It means you're going to be tempted to use it, and if the situation gets dire enough, or the list of victims looks horrendous enough and pathetic enough, you might go forward and start wielding your weapon and maybe fire some shots in the air. The fired shots in the air, I think, for China are going to be moving the gold price up $100 on a single day and the silver price $1.50 on a single day. You wake up in the morning. Their day is our night. So from our perspective is overnight, the silver price is going to go up $1.50. Overnight, the gold price is going to go up $100. Okay, so now Shanghai has the ability and the device to lift gold and silver prices. All they need now is the motivation and the decision to do so. The actions of the week, during the week of April 19th, are precisely what motivates China to take action. They warn the West, don't continue to throw paper at the gold and silver market. And that's exactly what they did to prevent the move over 1,300. It's exactly what they did to slow the move to 18. And now here we are. We're not stuck. We're consolidating under 18. Wow. So they've got the device. China could make announcements that there are way too many shortages in both gold and silver, and that is the justification for a quantum jump higher, a nonlinear, a discontinuous move higher. Anytime you hear nonlinear, discontinuous, just think a sudden move up that didn't gradually go up $1, $1.25, $1.50, $2, $2.25, $2.50, $3. No, it just moved up $80 and then suddenly it's up 120. That's a discontinuous move. They don't have a dearth of justification. There's plenty that they could rely on for announcing, like, say, shortage of supply. Later, they can come out and say, we're quite certain that the gold price, now that it's moved to 2,000, we think that it will probably make moves toward the 3,000 mark rather quickly because we've not achieved equilibrium. You know, you study the economics textbooks, and what's amazing about these economists, in addition to not getting much of any forecasts correct, they don't really mention the supply and demand curve anymore for price setting. They say, no, it's done at the margin with price discovery mechanisms, namely paper gold and paper silver. They don't like talking about the equilibrium of supply and demand because that's so old-fashioned and yesterday. Okay, you're going to be hearing more about achieved equilibrium for supply and demand because there's not going to be any until we get up way past $5,000 gold. There's new demand coming in. It's going to be for the currencies. There's a lot of talk before the April 19th date with Shanghai of arbitrage coming in. And I noticed on that week, I got about 3 or 4 emails from clients who said, Jim, check the Shanghai price. The gap between the COMEX gold and the Shanghai gold is getting bigger. I don't think China is quite ready now to make a big fat, say, $50 difference between the Chinese price and the London price for gold. I don't think they're quite ready. But here's what arbitrage would be. Arbitrage is a nice fancy French word that means exploit a difference. So they could buy in London lots and lots of gold bars and commit them for sale in Shanghai at a higher price. Well, that's only possible if they can get gold in London. If there's no gold to be obtained in London, there's no arbitrage. And I think this is what China's going to conclude. There's no arbitrage potential. So let's just jack these guys with a hot poker up their rectums and move $100 higher on the overnight price and see what kind of political reaction we get. See if in 24 hours you have an announcement of a certain bank like HSBC in London coming forward and saying, we're going to have to declare bankruptcy. Okay, this could be what's in mind for China as they become disgusted that there's no arbitrage potential. Now, the only draining of gold in London comes from the elite, very high-level families who point out criminal fraud, for instance, in the entire foundation for the euro monetary system. That was the basis for the draining of 1,000 tons of gold starting in March of 2012. 1,000 tons a month for 30 straight months. There's another big factor here, Elijah. China's really just waiting for the Western financial banking system to collapse. And unfortunately for China, they have to wait more, but they're very good at patiently waiting. The Westerners are not very good at waiting for anything, including, tomorrow's breakfast. China does not want to be blamed for the Western financial system collapse. So that would be a deterrent for them to jack up the gold price $100. But they might do it anyway, claiming that, gosh, if your banking system couldn't handle a mere $100 move in the gold price, then there's something wrong on your side. You need to fix it. But the frustration with China is they just did not imagine, this is my opinion, they didn't imagine that the West could produce so much volume in QE for bank relief. They didn't imagine, for instance, that the Fed would recruit the BLICs of BLICS. I get this. Belgium, Luxembourg, Ireland, Cayman or the Caribbean, and Switzerland. They didn't imagine that over a 2-year period in 2014 and earlier, they didn't imagine that the BLICs would have an equal amount of QE volume to purchase treasury bonds compared to the Fed itself. That's remarkable. During that period, there was $400 billion worth of Fed purchases of treasury bonds. There was an equal amount of $400 billion from the BRICS nations. The Chinese just didn't expect that the BRICS nations would have $400 billion in treasury bond purchases and be sure to know that the money would come from the Fed itself in dollar swaps. So the dollar is moved from the Fed to Belgium, where they also had this absurd $430 billion boil sitting in the Belgian central bank ledger item. And by the way, that's more than the entire Belgian economy. Can you imagine having a boil on the side of your neck, Eli, where the volume is bigger than your body? That's the Belgian boil for treasury bonds. I mean, there were stories later that it was really just Euroclear using the Belgian central bank as a way station to hold the treasury bonds that China and other nations in the East were dumping. Okay, all right. And who was buying it up? The Fed, sending cash through the dollar swap facilities to the BRICS nation that they recruited. That's called exported QE. Sorry about my voice. Exported QE policy with third parties. Okay, these are extraordinary measures. I think the Chinese are just losing patience with the West. They've got plans. They got plans, and they don't want to see any further deterioration of the global economy. The Chinese don't want to see any further deterioration with the emerging market nations that actually have industry and savings that are undermined by QE and the monetary policy. There's so many moving parts here, Elijah. It's both exciting and frightening.
The next topic I'd like to discuss is how certain bank failures from their energy portfolios affect the gold price and release. Did you want to discuss a little bit about this?
Yeah, it's kind of interesting how it might play out. I've talked to some people and they say, well, gosh, if you see the energy portfolios, I don't see any relation at all to gold. Well, let me explain a possible sequence of events. To begin with, the Dallas Fed has ordered, this was back in January, not ordered, but strongly suggested that the big banks not mark to market their energy portfolios and allow these energy firms more time to make good on their debts and maybe through some asset sales. But by the way, those aren't going very well either. They're only getting like 50, 60, sometimes even 30 cents per dollar on their asset sales. So the energy firms are really they're really in trouble. I mean, words just don't fit. They're in dire situation here. They can't work their way out of it. Okay, so now you had April with the quarterly announcements for a lot of big banks, and it was a bloodbath. It was very ugly, and I expected it to be ugly, and it turned out to be about as ugly as I thought. The big banks have done something nasty again. They've encouraged some of the energy companies to do a stock secondary issuance. And they didn't exactly mislead the stock investors, but I don't think they properly informed them through disclosure. The proceeds from the stock issuance were to pay down debt to Wall Street itself. Many of them were involved in what's called the revolver loans. Think of it as a corporate credit card with, say, Bank of America behind it. Well, now Bank of America, JP Morgan, Goldman Sachs, they're pulling these credit lines because the energy firms are in such trouble. They're going down. They're going down in flames. So don't extend more credit lines to them when they're dead. Okay. The big banks are going to get harmed. It's a tough question. What is going to bring down the first three big American banks? Well, for sure, the energy portfolio is going to be a big part. I don't think it's necessarily going to be their gold short positions. I don't think that's going to be it. The general economy is certainly a big part. If you're looking at some of the bankruptcies out there and the defaults, an overweight, a higher percentage than you would expect is coming from the energy sector. Okay? So, as these big banks start to fail, and I don't really know when or how the process is going to happen. I come up with a lot of opinions and formulated scenarios, but suppose you start to see a number of big banks fail. They might, on the sly, take borrowed Fed money and buy gold. I mean a lot of gold. And if you look at the big movement in the price of gold just since January, and not just the United States, but in terms of the euro as well, it might be that the big banks are participating in this gold rally, adding to their gold reserves, and I don't think you're going to see it on their financial statements. Oh, Jim, that would be fraud. Yeah, that would be fraud. It would only be the 87th example of fraud. So don't tell me that they can't do that, because fraud is their middle name. Okay, once a number of big banks have a sizable gold position and a pattern of acquiring gold in a manner that can be moved quickly to their balance sheet for disclosure, they might all collectively agree upon something with the Fed itself and with China and Shanghai and say, okay, green light, time to make this move in gold happen to recapitalize the Western banks. That's a connection, Eli. And I think it's already and set for a plan I don't think it's too far along in execution. But when it does happen, I think you're going to see perhaps a sudden doubling of the gold price and a tripling of the silver price. A move like, toward 4,000, between 3,500 and 4,000 in gold, and a move like between 50 and 70 in silver quickly in order to recapitalize the Western banks. Now, if that's not irony, golly, I don't know what is. Imagine the Western banks, the arch enemy of the gold market, riding the back of the first major leg up toward 10,000. Now, it could be that the big banks will say, no, we're not going to do that. But after they get toward 2,000 in the gold price, say without the big bank participation, I think you're going to see a lot of banks joining and saying, we don't think 2,000 is the destination. We're hearing a lot of inklings. We're hearing a lot of indications. We're hearing a lot of stories and rumors and verified plans that we're going to be going to 8,000 to 10,000, maybe even 12,000 in the gold price, and then you're going to get maybe a late move by the banks. I don't know whether they're going to be on the first leg or the second leg, but I'm convinced the big banks are going to be involved in some of the legs in the gold move toward 10,000.